Okay, so let's unpack this. How does a company, one that was viewed with, let's say, deep skepticism over its massive metaverse bet,
Right, yeah.
suddenly have a landmark financial quarter, propel its stock to new record highs, and announce even more massive spending?
Without missing a beat.
Exactly. It almost sounds, too good to be true.
It does. Yet that's precisely what happened with Meta platforms in Q2 2025. It's a remarkable turnaround.
Mm-hmm.
And what's really striking is how profoundly different the market's reaction is this time. It seems to be all about how Meta has redefined its path, its strategic trajectory.
Centered on artificial intelligence.
Exactly.
AI.
That's why we're here today. For this deep dive, we've gathered a stack of sources, official earnings reports, transcripts, analyst notes, market commentary, basically everything we could find to pull out the most important nuggets for you.
Our mission today is really to unpack how AI isn't just influencing Meta's current financial success.
Right. But genuinely redefining its entire future strategy. We'll explore why the market is embracing this new spending spree, maybe with open arms, and what it all means.
For the company and for you, the curious learner. So let's start with the big picture, the headline. The shocking outperformance.
Yeah, it really was.
Meta delivered financial results that, substantially exceeded Wall Street expectations.
Big time. Revenue hit $47.52 billion. The consensus was, around $44.8 billion?
Yeah, way off. And diluted EPS, that's earnings per share, came in at an incredible $7.14.
Versus expectations of $5.85. Huge beat.
And the market reacted instantly. Shares surged over 11% after hours, hitting new record highs. Just a massive win.
What's really insightful here, though, is how this happened. This really strong performance coincided with a bold, decisive pivot towards AI.
A future centered on AI.
Right. And this isn't just a small shift. It feels like a strategic revalidation of their core tech. Remember the metaverse bet?
Oh, yeah. Deep skepticism, valuation pressure, lots of eye rolling from investors, frankly.
Exactly. People are asking, where's the ROI on that?
When will we ever see it?
Yeah. But this current AI spending cycle, it's being embraced. That's the crucial narrative shift here.
Okay, so what's the key difference? Why now?
It seems the investment in AI is directly linked to tech that's already delivering tangible results. Measurable results.
A highly profitable one.
Highly profitable results, exactly, in their core family of apps segment. So now investors see this aggressive spending as necessary, prudent even.
Because they can actually see the impact right now.
Precisely.
So how did they translate this shift into such impressive numbers? Let's dive into the financials a bit.
It was really an operating leverage masterclass.
Okay.
Revenue grew a solid 22% year over year, which is great on its own.
Fantastic, yeah.
But here's a kicker. Expense growth was controlled. Only a 12% year-over-year increase.
So that gap.
That substantial gap created powerful positive operating leverage. Their operating margin surged 500 basis points, climbed from 38% to an exceptional 43%.
Wow. That's a seriously impressive jump in efficiency.
It genuinely highlights their, maybe, newfound efficiency and strategic cost allocation.
Right.
You look at R&D,
Okay.
increased 23%. Mostly employee compensation and infrastructure costs for the AI push.
Makes sense.
But then general admin expenses actually decreased 27%, mainly due to lower legal costs compared to last year.
So they're spending where it counts.
Exactly. Investing heavily where it matters, without losing overall financial control.
And that efficiency flows right to the bottom line, I assume.
Absolutely. Net income grew an impressive 36% year over year to $18.34 billion.
$18 billion.
Yeah. And what's more, even after spending $17 billion on capital expenditures,
Which is a lot.
they still generated $8.55 billion in free cash flow. Plus, they returned value to shareholders, repurchased almost $10 billion of stock, paid over $1 billion in dividends.
Solid performance all around. What about users? Are people still logging in?
They are. Sustained growth there, too. Family Daily Active People DAP reached 3.48 billion in June. That's up 6% year over year, beating estimates.
3.5 billion people using their apps daily.
Roughly. And headcount also increased 7% year over year to nearly 76,000. Targeted hiring, they said, in AI, monetization, and reality labs.
Right. So all this together, analysts are calling it Meta's golden quarter.
Mm-hmm.
And it's not just about the good numbers, it's that it highlights something strategic.
Totally. It shows that Meta's AI-driven ad efficiency is currently generating cash faster then their ambitious AI R&D is consuming it.
Ah, okay. So they have this financial cushion.
A unique degree of financial freedom in this AI race that, frankly, many competitors just don't have. It gives them the financial capacity and the strategic justification for the aggressive spending they're planning.
So how exactly is AI fueling this? We mentioned the strategy had two prongs.
Right. A powerful two-pronged strategy. On
Yeah.
one side, you have applied AI for today's business. That's the fuel.
Okay.
Management explicitly said strong advertising performance was largely thanks to AI unlocking greater efficiency and gains across our ad system.
And do we have numbers on that?
We do. Concrete data. New AI-powered recommendation models for ads delivered about 5% more conversions on Instagram and 3% on Facebook.
Which sounds small, but for Meta.
For Meta's scale,
Yeah.
that translates into billions of dollars. Billions.
Wow.
And AI also drove user engagement significantly. Time spent was up 5% on Facebook, 6% on Instagram, thanks to these AI recommendation systems.
That's fascinating. And it creates a kind of virtuous cycle, doesn't it?
Absolutely. Better recommendations mean higher engagement.
Which creates more ad inventory.
And more data to further improve the AI models. It feeds itself.
So this is their barbell strategy in action, the low-risk, high-return part.
Exactly. This immediate, quantifiable success generates immense profits and, crucially, builds credibility with investors. It's the engine keeping everything humming.
Okay, so that's one end of the barbell. What's the other end?
The other end is the superintelligence vision, the new North Star, you could call it.
Right. Zuckerberg's ambitious goal.
Very ambitious, to build personal superintelligence for everyone in the world. He defined it as AI that surpasses human intelligence in every way.
He said this is now in sight. That sounds like pursuing AGI, artificial general intelligence.
It certainly signifies that, a major long-term goal.
And they're putting serious money behind it, that CapEx guidance.
Staggering figures. They raised the full year 2025 guidance to $66.72 billion. That's roughly a $30 billion increase year over year at the midpoint.
30 billion more just for CapEx this year.
And get this, management explicitly said expect another year of similarly significant capital expenditures dollar growth in 2026.
Oh.
And an acceleration in operating expense growth, too. This isn't a one-off. It's a multi-year investment cycle.
Where's all that money going? Infrastructure.
A lot of it, yeah. But also strategic investments. They disclosed $15.1 billion in non-marketable equity investments, including a stake in Scale AI.
Scale AI. Critical for high-quality labeled data for training models.
Exactly. And then there's the war for talent.
Right. They need the best people.
Meta is aggressively recruiting top AI researchers and engineers, offering, frankly, eye-watering compensation levels. Zuckerberg is reportedly personally involved,
Really?
aiming for the absolute best and most elite talent-dense team. You see names like Alexander Wang being mentioned. It's a major push.
So just to recap the barbell, the success of the applied AI, the profitable part, is basically funding and legitimizing this much more speculative, high-cost, long-term venture into superintelligence.
Precisely. A bold gamble, no doubt. But it's built on a really strong, profitable foundation right now.
Okay, let's break down the segments then to see how this funding mechanism actually works on paper.
Sounds good. The family of apps, FOA, that's the profitability engine, hands down.
The core business, Facebook, Instagram, WhatsApp.
Right. It generated $47.15 billion in revenue in Q2, up a robust 21.8% year over year.
Okay, and the profit?
Even more impressive, operating income was a staggering $25.0 billion.
$25 billion in one quarter.
Yielding an extraordinary operating margin of 53%. 53%.
That's phenomenal efficiency. Was the ad growth just price hikes?
No, it was pretty healthy and balanced. Total ad impressions increased 11%, while the average price per ad increased 9%, so more engagement and higher demand.
Good combination. Any geographic highlights?
Yeah, particularly strong growth in Europe, up 24.4%, and rest of world up 23%.
Interesting. Are they diversifying revenue within FOA at all?
They are, which is smart. Other revenue grew an impressive 50% to $583 million. That's mostly driven by paid messaging on WhatsApp for businesses.
Okay.
And subscriptions from Meta Verified.
Got it. So FOA is the powerhouse. Now the contrast, Reality Labs, RL.
The strategic bet. Or maybe the ongoing experiment.
Yeah. The numbers look very different. Revenue just $370 million.
Up a modest 4.8% year over year, but dwarfed by $4.9 billion in expenses.
Resulting in a quarterly operating loss of $4.5 billion.
$4.5 billion loss.
Yeah.
In one quarter.
Okay, now at first glance, that sounds a lot like the metaverse skepticism creeping back in.
It could, but there's a subtle shift happening in the narrative. Management noted the modest revenue growth was due to increased sales of AI glasses, partially offset by lower Quest sales.
Ah, the Ray-Ban Meta smart glasses. I heard those sales were up.
Up more than 200% in the first half of 2025, according to them. So they seem to be emphasizing AI-enabled glasses over the traditional VR headsets now.
Interesting repositioning.
Exactly. And notably, RL's expenses grew only 1% year over year. Suggests disciplined spending there, even amidst the company's overall surge.
So by emphasizing AI glasses, launching things like the Oakley Meta Performance AI glasses.
They're consciously repositioning RL, moving it away from being just a metaverse R&D cost center, which attracted all that skepticism, towards being an AI devices unit, which makes the continued losses, well, more strategically coherent, more palatable to a market that's currently bullish on AI.
So the huge $25 billion quarterly profit from FOA is easily covering the $4.5 billion loss from RL.
More than sufficient.
And funding the entire broader AI ambition. It's a brilliant cross-subsidy. Allows them to fund these high-risk, long-term bets with today's profit.
That seems to be the core mechanism, yeah.
Okay, so with such a strong quarter behind them, what did management say about the future, the forward outlook?
Well, for Q3 2025, they issued pretty bullish revenue guidance, projecting $47.5 billion to $50.5 billion.
And the midpoint?
$49 billion. That was significantly above the pre-earnings consensus, which is around $46.2 billion. So strong near-term momentum expected.
That's good news for Q3, but they didn't stop there, right? They were very upfront about what comes next.
Very upfront. While not formal guidance for Q4, they expect slower year-over-year growth then, mostly because they'll be lapping a period of stronger growth from late 2024.
Okay, managing expectations.
And then came the big news, this massive multi-year investment cycle.
Right, the spending.
Full year 2025 expense guidance narrowed to $118 billion. That's 24% year-over-year growth.
Still huge growth.
And the capital expenditure guidance raised to $66.72 billion. Again, nearly a $30 billion increase over 2024 levels.
And they even gave a heads up about 2026.
They did, stated they currently expect another year of similarly significant capital expenditures dollar growth in 2026.
Wow. So another potentially $30 billion more in CapEx in 2026.
That's the implication, and that the total expense growth rate in 2026 will be above the already high 24% growth projected for 2025.
What's driving all that future spending?
Key drivers. A sharp acceleration in depreciation for the massive CapEx build-out.
Makes sense.
Higher operating costs for all that scaled-up infrastructure, and of course, employee compensation from the aggressive AI hiring.
So this feels like what some analysts called a rip the Band-Aid off strategy.
Yeah, that sounds about right.
Deliver the strong Q3 forecast, build up some goodwill,
Right.
And then immediately spend it with transparent news of this massive multi-year investment cycle.
It seems clearly designed to attract long-term investors. People aligned with this high-investment, high-growth AI thesis, setting expectations early.
Okay, but it can't all be smooth sailing. With any strategy this ambitious, there have got to be risks. What are the key headwinds Meta needs to navigate?
Management was actually quite explicit about the most acute near-term risk, the European regulatory threat, specifically the Digital Markets Act, the DMA.
Ah, yes. Always a factor in Europe.
It's a substantial concern. They've introduced this less personalized ads offering, LPA, trying to comply.
Right.
But they're worried the European Commission might impose further modifications that would make the user and advertiser experience materially worse.
And they warned about the impact.
A stark warning. An adverse outcome could have a significant negative impact on our European revenue as early as later this quarter.
Wow. That's concerning, especially since Europe was such a strong growth driver in Q2.
Exactly. Ad revenue up 24.4% there, so a big potential hit.
Okay, so regulation is number one. What else?
Execution and return on investment risk. Just the sheer scale of it.
Committing over $130 billion across 2025 and 2026 in CapEx alone.
It's a monumental logistical challenge. Can they actually deploy all that capital effectively? Data centers, servers, networks globally, on time, on budget.
Big question mark there.
And while the ROI on applying AI to current ads seems pretty clear, the ROI on the long-term quest for superintelligence, that's far more speculative.
Right. There's a risk they spend tens, maybe hundreds of billions.
without producing a breakthrough that actually translates into large-scale revenue.
Yeah.
And that could lead to a dramatic reversal in investor sentiment, kind of like we saw with the metaverse, potentially.
Yeah, a painful reversal. Finally, competition.
Fierce competition. And the talent arms race that goes with it.
They're not the only ones spending big on AI.
Not by a long shot. They're up against Google, Microsoft, OpenAI, Amazon, all investing billions.
Which drives up costs for everyone.
Especially for talent. Those eye-popping compensation levels for elite AI researchers put huge upward pressure on R&D expenses.
And there's always the risk of losing key people to competitors.
Constant risk. It really makes you wonder about the bidding wars happening behind the scenes for these top minds.
Okay, so wrapping this all up, to conclude our analysis.
Meta has definitely achieved a great narrative shift. The investor conversation has pivoted.
From the metaverse.
Capital-intensive, highly speculative metaverse.
AI!
Equally capital-intensive, arguably, but demonstrably effective AI, at least in the near term. Q2 provided the proof point, and the market has, well, unequivocally embraced it for now.
So the narrative has truly shifted. What's the new core debate then? If it's not if they should spend billions.
The question now seems to be whether its massive spending can ultimately generate a commensurate return on investment.
Right. It's about the long term. Time horizon and faith in management's execution.
Exactly. And what stands out to me are the key performance indicators, the KPIs we need to watch.
Okay, what should we be tracking?
Near term, say the next 1 to 4 quarters, definitely European revenue growth and that DMA impact, plus continued strength in FOA operating margins, and the balance between ad impressions and price per ad.
Keep an eye on the engine.
Right. Midterm, maybe 1 to 3 years. Track the CapEx deployment progress, how fast depreciation expense grows. Also, the growth rate of that other revenue, like WhatsApp business messaging.
And user adoption of their AI tool.
User adoption of Meta AI. Yeah, and sales figures for those AI devices coming out of Reality Labs. See if that repositioning works.
And long term, 3+ years out.
That's the big one. Scientific or engineering breakthroughs from the superintelligence labs. Can they translate foundational models into new, large-scale revenue streams? And ultimately, what's the return on invested capital, the ROIC, from this massive 2025-2026 spending spree?
That's the $100 billion question, I suppose.
Literally. Ultimately, Meta has entered a new, decisive strategic phase. Q2 was the perfect launch pad. It granted them the license, you could say, to invest for a decade of future growth.
But the challenge is execution.
Relentless execution in the face of significant and mounting risks. For now, though, momentum, the narratives, and the immense financial power of its core business are squarely on Meta's side.
So we've seen how Meta's incredible Q2 2025 performance, really fueled by AI, has given it the financial muscle and, importantly, the market trust to embark on an even grander, costlier journey into the future of artificial intelligence.
A journey with huge potential rewards, but also huge risks.
Absolutely. And as Meta commits these unprecedented resources to building personal superintelligence for everyone in the world, maybe here's something to think about. Beyond the financial metrics, beyond the strategic pivots, what profound societal shifts could this ambitious pursuit of AGI truly unleash? And how might that reshape not just our technology, but, our daily lives in ways we can barely even imagine today?